20 years ago, the largest country in the world disintegrated. What had been one became many, and each began a journey. Where did it take them?
In the United Kingdom, RT is available in Durley House, The Landmark, 41 Hotel, the Old Waverley Hotel, Egerton House Hotel, the Milestone Hotel, Summer Lodge Country House, Holiday Inn, the Bull, the Old Government House, the Rembrandt, the Cranley, the Chesterfield, the Montague Hotel, the Royal Park, the Rubens Hotel.
Hi, I'm Max Keiser. Welcome back to the Keiser Report. Time now to go to New York City. Speak with Barry Ritholtz of Ritholtz.com. Barry is a market analyst, blogger, journalist, and author of Bailout Nation. Welcome back to the Keiser Report, Barry.
Thanks for having me, Max.
All right, Barry, first let's talk about your piece in the Washington Post. What caused the financial crisis? The big lie goes viral. Tell us about it.
Well, there's been this tendency amongst people who helped create the crisis, and rather than admit that radical deregulation and allowing bankers to set their own rules and granting special exemptions for the 5 largest banks to ignore the leverage limitations, or allowing derivatives to be completely unregulated with no reserve requirements and no counterparty disclosures, rather than say, hey, this was really a big mistake, oops. Instead, they've created this false narrative, this argument that, you know what really caused the crisis? It was the government forcing banks to lend all that money to minorities and inner-city poor people. That's what caused the crisis. The fascinating thing is the data overwhelmingly says that's not the case. We know they took leverage as soon as they were given permission from 12-to-1 to nearly 50-to-1. We know that they engaged in all sorts of speculative activity where they didn't understand the risks. Their models were just wildly optimistic. They were so busy counting profits and bonuses that they didn't pay attention to the bottom line. Look, it all comes down to some very, very simple rules. Banking is supposed to be boring. The job of a banker is to make decisions about who is creditworthy and who is not. To give you an idea of how reckless the banking industry became, not only did they create these no-doc loans, they stopped validating loan-to-value of the home. They stopped valuating credit scores. And most importantly, they stopped asking borrowers how much money they earned. And that is the single most important factor in determining if someone's going to repay a mortgage or a loan. How much do they actually earn? Can they service that debt? So when I hear this nonsensical things, banks were forced to make loans to poor people, nobody told the banks, don't check income, don't check credit rating, don't check all the usual metrics that have worked for thousands of years. It's just nonsense. And when I see people propagating the big lie like that, it makes me stop and say, what are these guys hiding? And it's pretty clear what they've been hiding. They have an intellectually bankrupt ideology, and it's causing global damage to the economy.
All right, you mentioned the leverage ratios being increased from 12-to-1, and the banks are leveraged at 50-to-1. Even the Federal Reserve Bank itself is leveraged 50-to-1. That goes back to 2004, I believe, when Greenspan lifted that cap. But you refer to that as ignoring leverage limitations. But isn't that a hard-coded law in terms of what the leverage limitations are according? Aren't there laws in place? Does it go back to the Basel?
Yes.
Okay. So they are therefore...
Well, now, it depends on who, Max, it depends on which financial institution you're talking about. If you're talking about depository banks, they have reserve rules which are implemented by the FDIC and others. If you're talking about investment banks, there's the 1975 rule that limited them to 12-to-1. The 5 biggest investment houses in the U.S. got a waiver of that. Ironically, it was called the Bear Stearns waiver. Bear Stearns, Lehman, Merrill, Morgan, and Goldman. The only ones somehow exempted from that law. Stop and think about what that means. Here's a law that applies to everybody except you 5 guys who happen to be the single biggest donors to Congress. And that, by the way, that waiver was granted by the Security and Exchange Commission. The Basel rules for depository reserves, how much they have to hold. What's fascinating about those is they've been whittled away over time, so the amount in reserve has come down fairly substantially, which allows their leverage to go up. So anything that gets in the way of profit, regardless of risk, there is a lobbying effort to try and reduce that. It was very successful with the SEC. It's been somewhat successful with the Federal Reserve and the FDIC, and that's why there's so little capital in all these banks, both in the U.S. and Europe. In fact, the underlying cause of the entire global headache that we're still dealing with is too little capital, too much leverage.
All right, so the law is that they have to have a certain amount of capital versus leverage on the books. And what happens and what we've seen is that if anyone starts to sniff around, then they do something like what Lehman Brothers did with the famous Repo 105 scam, where they simply moved debt off the balance sheet temporarily to satisfy a regulator that might be looking at them. And then when the regulator leaves the room, they put that debt back on their balance sheet. Isn't that also the case? These off-balance sheet entities are hiding huge debt.
First of all, what Lehman Brothers did with 105, that's just fraud. Let's not mince words. Let's not pussyfoot around with this. They're a bunch of criminals. Some of them should go to jail. And unfortunately, most of our prosecutorial staff are too busy chasing other nonsense. But there's just no doubt in my mind that Dick Folds and his CFO should be wearing striped suits with numbers. That is criminal. You cannot hide $100 billion or $50 billion at a time in spending and then put it back at the end of the quarter. I don't know where the SEC is. I don't know where the U.S. Attorney General is. It's laughable. That's number one. Number two, if you look at the movement that's starting to pick up a little speed in the United States, people have been moving their money away from the big banks to the small local community banks. And what we found is that these small community banks, they're much more solid. They weren't involved with derivatives. They weren't involved with subprime lending. They embrace what we call boring banking. They borrow money at 4%, they lend it at 6%, and they're out on the golf course at 4 p.m. And that sort of local community banking, that sort of credit union banking is potentially the biggest threat to the major banks. There's 6,000 or 7,000 of these banks in the United States. Some of them are 5 and 10 branches large. Some of them are 1 or 2. They're all insured by the FDIC, so your money is safe there. It hasn't been enough to affect their quarterly earnings yet, but if that were to happen, I think you would really start getting people's attention.
All right, Barry, we've been watching these banks commit massive fraud, not the community banks and the credit unions, as you were just mentioning, but the too big to fail banks, the big Wall Street banks. They're in violation of the minimum capital rules without a doubt. They're violating the law every day. We've been watching this grow over the past few years. But recently, just this past week, I think we're setting a new standard for criminality with the MF Global scandal. It seems that they're just reaching right into people's accounts and taking their money directly. Barry, talk to me. Is this a new chapter in the fraud?
Max, what do you think? It's your money? You think you're entitled to your money? That's our money. And if we decide we're going to need it to leverage up even more, the hell with you, we're taking it. MF Global is just a whole different order of magnitude. This basically, you know, when you fill out an account form, there are all sorts of things about what the bank or the investment house can do with your stock, let's say. We can hypothecate it, we can short against it, we can lend it. There's a bunch of things that could be done, and it's supposed to be governed and regulated pretty clearly. There's a pretty bright line as to what you can do and what is just out-and-out theft. At least what it appears so far at MF Global, and maybe they'll find the missing $600 million. Maybe, you know, it's in a drawer or someone made a line entry somewhere that's wrong. But from the appearances we've seen, this looks like someone just backed up the truck, wiped out the client's money, and said, the hell with them, we're stealing it. It's just beyond outrageous. And I think if anybody is going to jail in this whole past 5-year period, it has to be someone from MF Global. If they can't find this money, there's no other description for it. It's just grand theft.
All right, now J.P. Morgan and Bank of America, creditors to MF Global, are saying their claims come ahead of the customers. Is that proper?
You know, when you're involved in this sort of bankruptcy litigation, everybody says that sort of stuff. I think that there's some insurance on the accounts and there's some guarantees, but if it turns out that the creditors have a superior claim to people who are opening accounts, why the hell would I ever open an account with anyone again? Mattress sales are going to tick up because that's going to become the new banks. It's unthinkable that somehow an outside creditor is going to have a superior claim to somebody who actually had their money with a brokerage firm. In this case, it's a combination of SEC and commodities futures regulators who are supposed to be watching this. Look, the key takeaway from all of this is regulators can only do so much. If someone is intent on stealing, they're going to steal. What you have to do as a regulator or a government is make sure that when these people get caught, they get thrown in jail as a discouragement to other people. My takeaway from the crisis of 07, 08, 09 is steal whatever the hell you want and run for the hills. Nobody cares. No one's going to prosecute you. Maybe MF Global will get us to the point where someone goes to jail and that acts as a discouragement to future people. But right now, the lesson that they're going to be teaching in business schools is don't do what Lehman did. Don't just screw up a little bit. Do what Bear Stearns did. Screw up really big, and don't worry if you're a bondholder, you'll be made whole.
Yeah, I don't think a lot of people realize that when you open a brokerage account, you sign off on documents that you're bound to arbitration for any disputes. You don't get to go to a jury.
That's correct.
You don't get to go to a judge. 98% of all complaints against the industry are unresolved. Nobody ever gets their money out of the industry. And the pari passu to that, Judge Rakoff on the Citigroup case, the $285 million that Citigroup stole. Judge Rakoff says that, well, the SEC is going to have to figure this out because the federal judicial system doesn't have dominion over these criminal acts. So there is no law governing the criminal acts of these various banks, is there?
It's good to be the king. Listen, you know, when you have a congressional system that is based on eBay, when you could buy a congressman or a senator, when they get sold to the highest bidder, who gives a f*** about regulation? Who cares about any of that? You can do whatever you want.
We have about 30 seconds left. What do you think about this story that Congress is legally allowed to engage in insider trading with pre-IPO stock given to Congress people? It's not legally considered to be a bribe. Your thoughts?
It's consistent with everything else we know about the Parliament of Whores that is the U.S. Congress. They are up for bid. You know, we really need a third party to actually see if we can maximize how much we could sell them for. Place your bet, buy a congressman, get whatever regulation you want passed. That's how America works in 2011.
All right, Barry Ritholtz of Ritholtz.com. Thanks so much for being on the Keiser Report.
My pleasure, Max. Sorry to make you work with the editing.
No problem. That's going to do it for this edition of the Keiser Report with me, Max Keiser, and Stacey Herbert. I want to thank my guest, Barry Ritholtz of Ritholtz.com. You can follow us on Twitter. You can follow us on Facebook. You can follow me, Max Keiser, on Twitter. And follow me instead of Stacey Herbert because I'm trying to stay ahead of her. And trust me, that's what you want to do. If you want to send me an email, send it to keiserreport@rttv.ru. Until next time, Max Keiser saying, bye, y'all.